What if I told you that a simple photo from last year's Berkshire Hathaway meeting could be the key to understanding a pending financial catastrophe? A catastrophe that could wipe out trillions of dollars and shake the very foundations of America's banking system. These two innocuous-looking signs, held up by none other than Warren Buffett himself and his now late business partner Charlie Munger, contain a warning so dire that it's causing the Oracle of Omaha to dump his entire stake of Bank of America, once one of his top 3 biggest investments of all time. Buckle up, we're about to dive deep into a financial mystery that could change everything you thought you knew about the safety of your money. Let's start by decoding Buffett's cryptic message. Those two signs, available for sale and held to maturity, might seem like gibberish to the average person, but in the world of high finance, they're a sarcastic jab at a dangerous accounting practice that's allowing banks to hide massive losses from the public eye. Here's the truth. During the COVID-19 crisis of 2020, banks went on a buying spree. They purchased a staggering $2 trillion worth of treasury bonds and mortgage-backed securities. These were considered risk-free assets, backed by the full faith and credit of the US government. But there's a catch. A big one. These bonds were bought at the highest prices ever seen in the history of our capital markets. And guess who was the biggest buyer? Yep, Bank of America, scooping up a whopping $700 billion worth of these overpriced assets. Now, you might be wondering, why would they do that? Well, the banks didn't have much choice. The government had printed trillions of new dollars which flooded into the banking system. With lending at a standstill due to the economic shutdown, banks had to do something with all that money. So they bought bonds, very, very expensive bonds. Fast forward to today, where interest rates are much higher, causing the value of these bonds to plummet. And here's the thing that gets really scary. Bank of America's losses on these bonds are estimated to be around $100 billion. Let that sink in. $100 billion in losses. That's half of the bank's tangible equity. And remember, they owe depositors $2 trillion. If there's a run on the bank, it would be game over. You thought that was the bad part? Nope, there's more. Remember those signs Buffett held up? They're pointing to an accounting loophole that lets banks hide these massive losses. By claiming these bonds are held to maturity, banks can pretend those losses don't exist on their balance sheet. Buffett's gesture was a warning shot, a plea for Bank of America to address this ticking time bomb, but they did nothing. And now Buffett is selling every single share in what can only be described as a massive fire sale. The implications of this are staggering. We're not just talking about one bank here. The entire US banking system is sitting on $1.3 trillion of these potentially toxic assets. As global markets lose faith in US government bonds, interest rates are climbing even higher, exacerbating the problem. We've already seen the consequences of this play out with the collapses of Silicon Valley Bank and First Republic Bank. Those failures cost investors $40 billion. But if a giant like Bank of America were to fail, the losses would be catastrophic. So, what does this mean for you, the average American? As this crisis comes to a head, expect to see gold and silver prices soar. Bank of America stock could plummet, and brace yourself for a barrage of government assurances that your money is safe. But here's the cold, hard truth. Your money might already be gone. They just don't have to tell you because those assets are conveniently labeled as held to maturity. The question now is, what will you do with this information? Will you act to protect your financial future? Or will you continue to trust in a system that's built on a foundation of sand? Ultimately, the choice is yours. But remember, in the world of finance, knowledge is power, and now you know.